Chapter 13, Corporate Governance. The topics in this chapter include agency conflicts and corporate governance. What is an agency relation? An agency relation arises whenever one or more individuals, called principals, hires another individual or organization, called an agent, to perform some service and then delegates decision-making authority to that agent. If you are the only employee and only your money is invested in the business, would any agency problem exist? No. A potential agency problem arises whenever the manager of the firm owns less than 100% of the firm's common stock. Would hiring additional people create agency problems? An agency relationship could exist between you and your employees if you, the principal, hired employees to perform some service and delegates some decision-making authority to them. Who bears the cost of the perks? If the owner or manager owns all the stock, the owner or manager bears all the cost. If there are also outside shareholders, they bear some of the cost due to the owner or manager's perks. Therefore, minority shareholders will pay less for shares of stock. This is an agency cost. Agency cost of debt. Creditors anticipate possible harmful actions by stockholders. Creditors charge a higher interest rate. Companies' cost of capital goes up. Value of companies goes down. This is an agency cost. What actions reduce agency cost of debt? Securing the loan with company's assets, placing restrictive covenants in debt agreements. The borrower must maintain profitability ratios and retained earnings at a certain level before making any distributions to shareholders. Maintain debt ratios at specified levels. Not issue more debt. The modern corporation. Many shareholders now who own a controlling interest in a company. Decision-making delegates by shareholders to an elected board of directors. Board delegates most decision-making to hired executives who often hire other employees and delegate some decision-making. Potential agency conflict between shareholders and managers. 6 potential problems with manager behavior. Expend too little time and efforts. Consume too many non-pecuniary benefits. Avoid difficult decisions. Close plans out of loyalty to friends in company. Six problems with manager behavior. Continued. Reject risky positive net present value projects to avoid looking bad if project fails. Take on risky negative net present value projects to try and hit a home run. Avoid returning capital to investors by making excessive investment in marketable securities or by paying too much for acquisitions. Massage information release or manage earnings to avoid revealing bad news. Corporate governance. Corporate governance is a set of laws, rules, and procedures that influence a company's operations and the decisions made by its managers. Sticks, threat of removal, and carrots, compensation. Corporate governance provisions under a firm's control. Those provisions include board of directors, charter provisions affecting takeovers, compensation plans, capital structure choices, internal auditing, controlling system. And takeover provisions. Targeted share repurchase, for example, we call it green mail. Shareholders' right provisions, for example, poison pills. Restricted voting right plans. Stock options in compensation plans. It gives owner of option the right to buy a share of the company's stock at a specified price, called the strike price or exercise price, even if the actual stock price is higher. Usually cannot exercise the option for several years, called the vesting period. Problems with the stock options. Manager can underperform market or peer group, yet still reap rewards from options as long as the stock price increases to above the exercise cost. Options sometimes encourage managers to falsify financial statements or take excessive risks. Block ownership. Outside investor owns large amount of block of company's shares. Block holders often monitor managers and take active role, leading to better corporate governance. Regulatory systems and laws. Companies in countries with a strong protection for investors tend to have better access to financial markets, a lower cost of equity, increased market liquidity, and less noise in stock prices.